so much for being here. It wouldn't be a party if we didn't have all of you. You know, everyone is asking, is our business ripe for disruption? I don't think there's any question the most eminent disruptor is the proposed fiduciary rule. But while this could have an incredible impact on our industry, there are other forces at work changing our business. Now, technology can disrupt or enable an industry, and there's a lot of examples of this playing out right now. Google certainly believes insurance is an area of focus. They feel that it's in fact one of the two most potential areas for disruption. That's why they've launched Google Compare. It's their first foray into insurance. Will it disrupt or enable the P&C business? They are licensed in 50 states. They have pilots running in 3 states. The original companies, other than MetLife, were not names that you would exactly think of as household names. But now, USAA has joined their pilot, a name that is well respected. This could be a big development. The dilemma for P&C companies, do they want to get on board now or wait and hope it fails? But then will they regret it? Let's look at how disruption occurs historically. Many of you bought the same album multiple times, right, as technology changed. That was good for the music industry, but those days are gone because a lot of people are now finding music for free. You can get it streaming on your computer or on your smartphone. You can't talk about disruption without mentioning Uber. Today in New York City, there are 13,000 registered taxis. There are 14,000 Uber vehicles. But in Jakarta, Uber itself is already being disrupted. A young entrepreneur has started a similar service, but you get picked up on a motor scooter. Given the traffic in Jakarta, this is by far the faster means of travel. So change is pervasive. It affects all aspects of the economy and every industry. In 2007, Garmin was on top. They didn't see the disruption coming. They thought they were well positioned for what they saw as a growing interest in portable navigation devices. But when the advent of the smartphone, who needed a separate device that gave directions? These are all examples of business models that changed because of advances in technology. But Garmin isn't dead. They did what well-run companies do. They adapted. They moved into the personal fitness space, and their fitness category is posting very strong growth. But there are other new technologies that have the potential to be highly disruptive. I think they're important because whether they affect our business or not, you have to think about how much other industries could change. An example of disruptive technology is 3D printing. 3D printing can take a digital file and turns it into a real three-dimensional object. This could revolutionize manufacturing. Some things that today are made in large factories will be able to be printed in your home. Now, on this website, Thingiverse, you can buy plans for things you might need. The digital specs are emailed to you, and you can print it yourself on a 3D printer. You could print your own car keys, your smartphone, a case for it. Though not commercially ready, GE's actually built a small jet engine, all of the pieces made on a 3D printer. 2 companies, in fact, have recently received permission to manufacture digital pills. Each prescription can be manipulated differently for each patient. What is that sound? That's the drumbeat of change, and no one is safe from the drumbeat of change. Some new business models are using technology to improve the delivery of service or increase productivity. Today, doctors are able to follow their patients through wearable devices or even visit patients via the internet or video chat. Today, many patients can get immediate service from a practitioner online. No need to go to the clinic if it's a simple thing like perhaps the cold or flu. Doctors are also using kiosks to treat children, especially in underserved areas. HealthSpot, in fact, has 25 locations with kiosks in Rite Aid pharmacies. Technology, changing and improving productivity and enhancing a business model. Is there a reason that people couldn't access financial advisors this way? If a client's visiting their primary advisor and they needed the help of a specialist for, say, retirement or life insurance, could this be a model in our future? But we also need to be careful that technology doesn't commoditize our business. If sites like Google Compare make it all about price, then how will you differentiate yourself? Now, sites like Kayak have certainly made it easier to compare fares for airlines, and Priceline made it easier to compare hotels. But now there's even a new player that may be even more disruptive. While Kayak and Priceline give the consumer the ability to see a number of offerings, they were limited to the deals on that site. Trivago aggregates the aggregators. It lets you see all of the different sites' best deals in one place. These sites are commoditizing their industries and making a bigger and bigger part of the decision price. Now, Policy Genius has created a marketplace where consumers can compare and buy a variety of insurance products, from term to renter's insurance, DI, and even pet insurance. And at least 3 of our members were initial investors. And many of your companies sell products on the site. But of the clients buying, 50% are millennials. So Policy Genius is reaching in a new way that elusive next generation. So while commoditization often drives down prices, and it certainly can change the competitive dynamics, it did not necessarily disintermediate the existing companies. In fact, in this case, for some, it actually increased their reach to more millennials. Now, has the life business been commoditized already? You know that a BGA is going to spreadsheet your product to see who's the cheapest. It changed your strategy. It didn't make you obsolete. The more that a product is a mass market product, the greater the odds that the internet would be a disruptor and could commoditize the product. The auto market is probably most at risk, but life insurance likely will be harder and will take longer to commoditize. Gary Hamel said, to escape the curse of commoditization, a company has to be a game changer. Companies have to differentiate themselves. They need to find a way to stand out from others, to do something better, or create a unique experience. I'm finding companies are finding ways to differentiate themselves. The Society of Grown-Ups started out as an experiment to see if MassMutual could learn anything by interacting in a different way with young consumers. Consumers liked it, and MassMutual is committing $100 million to the project and opening 10 more locations. Capital One has opened cafes to offer customers an expansive range of products and direct help and seminars. Both of these models break the mold and provide a distinctive experience. Segmenting the market is another way to avoid commoditization. Gaining a capability superior to others, being the best at something, targeting a specific group of people, and knowing more about their needs than anyone else. USAA has done it. They've developed a reputation for unrivaled service, but they also specialize in a specific market segment: people who have been in the military and their families. The product is the same, but the total value proposition is very different. By focusing on a particular market and understanding their customers' needs, they can serve their customers in a way that no one else can. Now, being on the Google Compare platform, this is giving them a way to leverage those strengths and what they've built to a whole new audience, broadening their distribution. They are taking advantage of the potential disruption. There will be winners and losers, but I don't believe disruption means that all companies go away. Now, disruption may actually start out as a segmentation strategy. Airbnb initially targeted budget-conscious travelers who wanted a low-cost option for travel. They actually believe they helped grow the overall market. Initially, price was the differentiator. But Airbnb says today it's not about price. It's about the experience. 91% of renters say they want to live like a local. They want a distinct experience. But now Airbnb is expanding into the business travelers market. It began as a segmentation strategy. Now it's clearly more disruptive. Where will the disruption come from in our space? One man to watch is Jack Ma. Most of you have heard of Alibaba. It's the eBay of China, but so much more. Alibaba announced a partnership with Yibao Tech, in which they describe the world's first internet insurance cloud platform. They claim that they can help a company create a new product in only 1 to 2 weeks, saving tremendous time and money. A company checks into their system, much like you'd check into a hotel. You'd leverage this array of capabilities that lives there without ever having to use your own existing system. Clearly, this part of their model is an enabler for companies, but maybe even for disruptors. But he's also launched China's first internet-only life company called Zhong'an. They claim to have sold, get this, 630 million policies in their first year. Alibaba has also purchased an online pharmacy as part of that direct-to-the-consumer strategy. But they also have joint ventures with CIPC and Allianz. Going direct, forming partnerships with other, disruptor or enabler. It's really getting hard to tell. Now, companies, all of you aren't just standing by idly, waiting for someone to move your cheese. You're segmenting the market in new ways. MassMutual has set up a separate company with the sole purpose of selling directly to consumers. The product that they sell online is different than what their producers sell. It has fewer features and it's priced lower. They're talking to a different consumer in a different way. AIG has made a real commitment to the Chinese American market. With its vast experience in China, AIG knows the Chinese culture. They're leveraging that knowledge to provide a different experience for Chinese Americans, providing producers with end-to-end Chinese language support, from sales materials to underwriting and even to service. The largest bank in Brazil started by selling accidental death insurance to low-income people, making it available on POS machines and smartphones. But now Bradesco is expanding its reach, leveraging 25,000 small stores, supermarkets, pharmacies, and even newspaper stands, places where the people are. It's allowed them to expand into an underserved market. Other companies are deciding to enter new product lines. Some of you thought I was crazy a few years ago when I suggested you should consider selling pet insurance. Remember that? Now, 1 in 3 Fortune 500 companies, 1 in 3, offers veterinary pet insurance as a voluntary benefit. Others are talking differently about how to target segments. They're thinking about how to cross-sell their existing clients. For that, Swiss Re has developed Launchpad, which aggregates over 4 billion consumer and business digital records. It applies their algorithms to the data to identify clients who are most likely to make or buy an additional purchase. All of these are strategies that can help provide some insulation from disintermediation. When we accept how different the world may be, we might be able to see new possibilities. There's that drumbeat of change again. Earlier, I showed you that doctors are using kiosks to serve their patients. Is this something we really should think more about? A bank in Mexico is doing it. Think about it. We have a generation of buyers who grew up looking at video screens. Isn't it reasonable they might want to be doing business that way? Emerging markets are no longer taking their cues from the more mature markets. They're being more innovative than we are. In China, AXA is having success selling life insurance from bank kiosks. Another company in the US is doing it here in banks. These companies are putting life insurance where it's convenient for consumers. 41% of those who shop for life insurance do it because of a life event, because they got married, they bought a home, they're having a child. Shouldn't we be present when there is the highest propensity to buy? We should be putting kiosks in hospitals' maternity wards. I mean, isn't it really the perfect place to make our products available? Parents could play a video game, and the kiosk could teach them about why their family needs life insurance. It could educate them about their choices, but then provide the opportunity to buy before they take their child home. Hospitals are already installing kiosks in waiting rooms. Couldn't we, shouldn't we be part of the content? There is no question. You are changing, and you are thinking much more about the consumer. But success is a journey. We have a long way to go. But companies are changing, and you're improving the odds of getting more of those millennials to buy. But these new initiatives are also making it harder for others to disintermediate you. What John Hancock has done is truly revolutionary. Working with Vitality, they're incenting clients to behave differently, to exercise and live a healthier life. As the client improves their fitness and their health, they earn discounts on their life insurance, but also immediate discounts on other products from retailers and partners. This employs many positive elements of behavioral science. But they're even more importantly, creating a long-term interactive relationship with that client. In fact, engaging them daily. Every time the client checks their progress on their Fitbit, they see Hancock's name on the screen. You know, our researchers say that only 3 in 10 Americans can recall a single insurance company by name. What are you doing to change that? Now, some companies are working with retailers and affinity groups to leverage their customer relationships to broaden distribution. Protective has had great early success working with Costco, and 40% of the apps are handled completely electronically without any human intervention. Now, this is what I believe is the distribution model of the future. Many people will start the buying process wanting to do it themselves, but along the way, they're going to decide that they want advice. Companies are going to have a slightly different role. You have to drive more traffic to your websites through all the modern tools available, but finding new and more engaging ways to get that customer really working with you. But then being able to provide them the ability to buy online or directing them to someone else for advice. So, will producers be a thing of the past? I don't think so. There are certainly companies that want to disrupt the advice model. Future Advisor provides software to track your assets for free. If you want help, you can pay $49 a year and access an advisor for broad portfolio advice, or you can pay $195 and talk with an advisor via FaceTime or video conference. Question: could a smartphone give advice? Many people's questions are pretty basic. Couldn't someone create an app for your phone employing algorithms that could answer many basic questions? It's actually rumored that Watson, IBM's supercomputer, is already working on it. It's coming, I guarantee it. Robo-advice in the investment space is certainly part of the new model. Companies are ramping up their investments in platforms that provide robo-advice. But they're also buying tools that can be leveraged by advisors to provide expanded offerings to their clients. Future Advisor started out as a disruptor, but now BlackRock's bought it. They're making it available to their existing retail clients for free. But they're also making it available as a B2B tool for banks, insurers, BD, and 401 platforms. Schwab is giving their advisors the option to use their robo platform. So while some advisors see it as a threat, others see it as a way to provide additional service and avoid being disintermediated. LearnVest is considered to be one of the best sites where people can go and learn how to manage their finances, paying for advice only when they need it. It's been brought by Northwestern Mutual. It could become a great source of leads for Northwestern's producers. Many people will start out believing they want to do it themselves, but they will become frustrated, they will have questions, and they will want help. This could really all be examples of how the advice model and companies' roles will morph. There's no question the robo model will continue to evolve. Companies and advisors should leverage it as a way to drive more traffic, find a new, better way to engage consumers, but then give people options of how they want their advice. Now, AXA is engaging consumers online. They've partnered with a company called Ingress. It's an online gaming company. They've created this highly coveted shield for this game. This game is played by over 12 million people. But to get that shield, more than 600,000 people have visited AXA agencies across the globe, creating leads for their advisors. Sun Life has created their version of Match.com to help their retirement clients find their perfect advisor, creating leads and cross-sell opportunities for their field force. Other companies are really experimenting with new ways to reach clients direct. Mangeral in Brazil created an online market to sell direct to consumers, small premium, simple products like AD&D and critical illness. Early sales exceeded expectation, both in count and in premium. But you know what they did? They made it available to their producers, and they let each of them create their own online store. The advice model is not dead. Producers do not need to be disintermediated by change if they begin to leverage companies' tools to help them be more productive and to expand into new markets. You know, when SelectQuote first started, it claimed one of the advantages of using them was you didn't have to work with an agent. Now it gives consumers the opportunity to find an agent to help them complete the sale. Our research indicates people still want and need advice. Even the millennials tell us they want help when it comes to buying life insurance or saving for retirement. What's more, many behavioral studies find that without advisors, people just don't always make good decisions. While I've described some possible disruptions to our industry, we have been disrupted already. The DOL proposed fiduciary rule will have a seismic impact on the way you do business. It is a disruptor. Our research tells us that people need advice and they want advice. We believe the data suggests clearly they are more likely to save and plan for retirement when someone helps them. The proposed rules will have a chilling effect on the future of advice in this country. Make no mistake, it will not just affect that retail advisor. It can determine what will be said when someone calls a contact center, what a wholesaler can tell an advisor, and even what people managing money for plans can tell plan sponsors. People will not be able to get the most minimal advice from non-fiduciaries on their IRAs. $7.6 trillion of assets. Now, we're not about advocacy, we're about research. I make these comments because, frankly, these are important trends that will alter our business. I'm firmly convinced this is only the beginning of rules that will limit your ability to provide advice. It saddens me and scares me at the same time. And it's inconsistent with what people tell our researchers they want and need. And as someone who's supposed to be thinking about trends, I shudder when I think about the unintended consequences. I have a million questions, and I see incredible downside risk. How much will this impact companies' ability to sell annuities? How different will future products or comp structures have to be? And will enough companies want to manufacture them? Will there be enough advisors willing to talk with clients about the need for lifetime income? How many will just leave the business? Is this the start of regulation by lawsuit? And is this the best way to regulate an industry? I can't help but wonder, isn't there enough well-thought-out regulation between what the state regulators and NAIC, FINRA, and SEC do? No matter how I think about it, I see lots of risk, and I am just not optimistic that consumers on their own will end up with better outcomes. And all of this is really coming at the worst time, when the largest number of people and their assets are moving into retirement. In the next 10 to 15 years, there will be an unprecedented shift of assets as the majority of boomers enter retirement. It is really likely that their financial goals will shift from accumulation to principal protection and income generation. They will need to change their investment strategy as a result. People will need help making all of these decisions, and there will likely be fewer people able to give them that advice. Is it any wonder that globally, across all industries, CEOs list the regulatory environment as their number one concern. You have huge challenges ahead of you, but huge opportunities as well. There will be winners and there will be losers. It's never as bad as it seems in the moment. I still have a lot of confidence you will find creative solutions to whatever comes your way. The examples of innovation I've highlighted are all part of the evolution of how we must change to get to that new consumer. In the end, people need what your companies provide. They need life insurance and disability to protect their families. They need good long-term savings vehicles, and more they're going to need monthly income. Change doesn't mean disintermediation for everyone. But one thing I know for sure, the drumbeat of change will continue. Good luck and thank you very much.